Alright, this is Wade on behalf of V Electronics, and in this video we're going to be talking about the interest rate risk. Okay, so interest rate risk. Now, when it comes to your interest rate risk, okay, we're talking about things like your monetary policies. Okay, so anytime there is a monetary policy, anytime the central bank introduces a monetary policy within the economic system, what's going to end up happening is, the interest rates will go up, if there is an inflation, if the economy is an inflationary economy, the interest rates will go down, they will reduce the interest rates if there is a recession, to boost the economy. All right, now, if they bump the interest rates up, we know from bank management from the last video that banks, they borrow short and they lend long, which means they make money off interest and they pay in interest as well. All right, so say, for example, if you have a bank, a commercial bank, and let's say they have $20 billion worth of assets. So let's say they have $20 billion worth of assets. And let's say, they've got, $10 billion worth of liabilities. All right, now, if the interest rates were 3%, how much is the bank paying and how much is it making? So we can do the math over here. So you have, 20, for example, times 3%. This is 0.6. So this will be 0.6. And obviously this is in billions. And then 10 times 0.03. Again, 10 times 0.03. This will be 0.3. All right, so this will be 0.3 billion. So suppose this is your asset, this is your liability. The bank is earning $0.6 billion and is paying 0.3 in terms of liabilities. Which basically means that they're able to earn interest while giving out loans and mortgages. And this is roughly $0.6 billion, relevant to loans and mortgages. And when depositors deposit money in the bank, whatever they make, whatever the depositors make, bank has to pay in terms of their savings account, as a result of which they're paying $0.3 billion in terms of savings, in terms of interest for savings accounts. So now, if you were to bump the interest rates up, so let's say we bump it up to 5%. All right, so now let's see what we get. So you have 20 billion. So 20 times 0.05. This will be 1. So this will be 1 billion. All right, and then 10 times 0.05. This will be 0.5. So this is 0.5 billion. So we know that you have to subtract your liabilities from your assets to get your profit. So this is 0.5 billions. 0.5 billion in terms of profit. Over here, it was 0.3 billion. Now because the assets are more than your liabilities, you're able to make a profit even though the interest rates go up. However, if you were to reverse the scenario, and let's say this was your liability and this is your asset, things will be different. So you will start off paying $0.6 billion in liabilities, and you will make $0.3 billion in terms of your revenue. Okay, and as the interest rates go up, okay, you will end up with $0.5 billion in loss. Okay, because this will be your liability, your new liability, $1 billion. And this is how much you make from your assets. Okay, when the banks give out loans and mortgages. Okay, so this is how much you make, 0.5. Okay, so liabilities take away assets, or assets take away liabilities. That's negative 0.5, which is $0.5 billion in loss. All right, so this is basically how bank management works. And if there is a loss because of a bump in the interest rates, okay, what you're basically saying is that there is an interest rate risk. Okay, just like you have a credit risk when it comes to the borrowers defaulting on their loans. Okay, you have an interest rate risk whenever there is a monetary policy being imposed on the commercial banks, as a result of which they end up losing money. Okay, so that will be it for this video. On behalf of V Electronics, this is Obaid. Have yourself a great day.